welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Linamar are trading higher after the company reported profit in its most recent quarter that topped estimates. Revenue also rose 16% to nearly $3 billion, surpassing expectations as well. Linamar says new U.S. tariffs will have more impact on its industrial segment, but won't impact its overall business outlook. You can see the S&P 500 up by a quarter. Dow, pretty much a wash. NASDAQ, though, bouncing back, and it is on a roll right now, up by 0.67%. Earnings beat and resilient consumers have pushed markets to new highs, but will the oil crisis and the Middle East conflict spoil the party? And where can you find investment opportunities? Let's find out with Maria Lorena, Director of Financial Research at Domini. And Marina, thank you very much for joining us. Excuse me, my throat's a little raspy right now. Thanks very much for joining us. Interesting times. We apparently have a war going on, an oil crisis, but the markets aren't even blinking right now.
That's right. I think, obviously, if we do get a resolution to this soon, it will be incredibly positive and helpful to the markets. And we're sort of waiting to see what's going to happen there. But in the meantime, I think the markets really have pivoted towards earnings and other data and sources of data that have been coming through in the last couple of weeks. And earnings have been good. They've been rather positive across the board. About 80% of the S&P 500 companies have already reported their earnings so far, and really solid, strong revenue growth, and really solid earnings growth as well across the board. I mean, clearly there are some better sectors than others, and for sure we've seen really solid performance from anything AI exposed, but broadly positive across the board.
And just going through this a little bit, what would it take for what's going on in the Middle East to get the attention of the markets again? Or the way it's looking, it looks like it's going to be settled, fingers crossed. But what would it take maybe to get the market's attention again?
I think that something would really have to go wrong, I think, in the Middle East, because, as I said, the earnings have been quite solid. The data has held up well. The consumer has held up well here in the U.S. so far, thankfully. Although we're seeing inflation, it's been coming through, mostly it really is explainable on the energy side. So if we can get a resolution in the not too distant future, that will be incredibly positive, I think, for markets.
And then with the earnings, should we see optimism moving forward with them too? Any signs that this might just be like a bit of a peak?
Well, I think the broad-based fact that the earnings have been rather broad and not sort of really nestled and in one particular sector or other has been very sort of helpful here. We've heard from a number of companies over the last couple of weeks that are consumer facing, and broadly although there are concerns there, and they are more hesitant as the year unfolds, the longer this conflict lasts. Broadly, we have not seen sort of a significant pullback so far. So obviously, if the longer this goes on, the more concerned we would become about the consumer. But for now, not terribly worried about things.
And we've got the U.S. jobs report tomorrow. What are you looking for there?
I mean, jobs have held up pretty well so far, no matter what data you look at. We've seen the JOLTS data this week, look pretty steady. We've also had some data coming out of ADP. It's been pretty positive. I mean, just holding steady, and I think that's what we need to see. It's really important that people keep their jobs because, as we said, the consumer is facing higher prices and is dealing with more difficult times. So jobs are really important.
All right. And then sectors, are you seeing where strengths and weaknesses that you're looking at?
Yeah, well, at Domini, we're impact investors. So really what we're focused on here is identifying companies that are able to solve problems, that can solve for choke points. So there are a couple of areas that we see, good opportunity. The grid infrastructure is one place where we see a lot of opportunity. Cybersecurity is another area that we've been looking at. From a grid infrastructure standpoint, I mean, this is something as impact investors that we're acutely aware of. We've known for quite some time that our grid needs to be upgraded and modernized for some time. And now with the increased power needs of data centers, we're really seeing that, and we're seeing a lot of companies benefit in terms of backlog growth there.
All right, and what a couple of picks we want to get into? Quanta Services, you're liking that? Is that within the green?
Yes. Quanta Services is a contractor. They supply, they work with grid and utility and other industrial customers on bringing their plants and facilities online, upgrading them, modernizing them. What's key here is that Quanta Services has a really skilled labor force. So, what you're getting with this company is the ability to actually bring these projects through and get them completed on time. And the fact that they have such a good and strong skills labor force has been very beneficial to them. They've been in a position where they've been able to sign long-term contracts with many of their customers, which takes them away from these fixed price contracts, which can be rather risky. Quanta Services has a very solid backlog of about $44 billion. It represents about 18 months worth of revenues, and they've got clear visibility through 2030 because of just the amount and level of projects that need to happen in terms of upgrading and modernizing our grid, and even just making our grid much more resilient as we face sort of stronger weather issues.
All right, and cybersecurity, Palo Alto?
Yeah, cybersecurity, I mean, I think you've seen already this year that there's been this divergence in sort of, the way tech companies have been performing year to date, with tech hardware up something like 17% year to date. Tech software, meanwhile, down 17%. We think there are some opportunities to be found in the software space, and we've been zeroing in on the cybersecurity names, and Palo Alto is one of these. They're a leader in cybersecurity. They're one of the largest players, although this is a very fragmented market. And they have the ability, like Quanta Services, actually to partner with their customers to provide their customers, a platform of products. And this is helpful to customers who might be looking for, ways to either save on cost or also to help them to sort of, plug gaps, because when you use multiple providers, oftentimes you've got some gaps in your security. So Palo Alto can help here. They have, also have signed a contract, or they have a relationship with Anthropic, and I think we've all heard about Anthropic's Mythos and how sort of powerful this is going to be. So it's really important that you have a partner who is aligned with Anthropic and sort of knows what's coming down the pipe.
All right, we have to wrap it up there, Maria, but thank you very much for joining us.
My pleasure.
Maria Lorena is Director of Financial Research at Domini Impact Investments. Coming up, today's market drivers with Bloomberg's Avalon Purnell. Time to take a look at today's market movers, and for that, we're joined by Bloomberg equities reporter Avalon Purnell. And Avalon, thanks as always for joining us. And let's talk about Datadog. No dog there. Hey, it's doing well.
Yes, it's definitely moving. Datadog is jumping 30% for its biggest one-day intraday leap since 2023. That's after the software company reported a very solid first quarter beat with earnings per share and revenue coming in well above expectations. It also boosted its full year guidance. And I thought one note that I really enjoyed was Evercore. They wrote that the guidance implies a healthy outlook for the second half of the year. And those results are lifting its peers like Cloudflare and HubSpot higher this morning as well.
And what do we know what's driving all this?
It's honestly just that positive sentiment. I mean, this is a company that is utilizing AI, and unlike other software names that have been pounded throughout the year, they're still coming up and being able to show good revenue each quarter. So we'll see if that momentum continues.
All right, so people are grabbing on to a winner right now.
Yeah. Well, now we can actually head on to kind of like the downside. So Whirlpool is falling about 14% to hit its lowest intraday level since 2011. Whirlpool reported earnings last night, and that print came in well below Wall Street's expectations. The household appliance manufacturer slashed its revenue forecast for the full year, and management did say that the war in Iran resulted in recession-level industry decline in the U.S. as consumer confidence completely collapsed.
All right, and last one, Planet Fitness needs a bit of a workout, doesn't it?
Yes, Planet Fitness also a little bit weaker today, tumbling 31% for its biggest daily loss since 2020. That's after the gym operator slashed its forecast for the full year as weaker than expected member signups at the start of the year met unfavorable weather. And one thing that they really called out was that it was particularly disappointing in that New Year's resolution period. They just did not have as many members joining as they originally expected. TD Cowen had a really great note out saying that first quarter results and management's comments were quite disappointing as trends seem to have significantly deteriorated.
Which is interesting. You would think that with everything with the weight loss drugs and the weight loss, people would be wanting to hit gyms to get in shape too. But I guess
I completely agree.
I guess some people are saying, nah, we look good. We don't need to be in shape. Well, we'll see what happens with that. All right, Monique. My apologies. We were having a little brain fart there. Avalon, thank you very much for joining us. And she's the Bloomberg equities reporter, Avalon Purnell. And up next, coming up, shares of Knight Therapeutics are rising as the company boosts full-year revenue forecast. We'll get some perspective on the Canadian pharma industry with the CEO of Knight Therapeutics after this. Airbus has delivered some good economic news. The plane manufacturer confirmed it landed a $19 billion deal to build A220 aircraft on Canadian soil for low-cost carrier AirAsia. The planes will be assembled on Canadian soil, and the buyer says he could buy more planes if Airbus built a bigger version of the aircraft. CTV's Quebec Bureau Chief Jean-Pierre Beauchemin reports.
The deal marks a big add-on to the Airbus order book, and floating in the air at the announcement, the prospect of yet another order for a larger plane. Malaysia-based low-cost carrier AirAsia signed on for the largest purchase of A220s in the manufacturer's history.
AirAsia is ordering 150 A220s for its major fleet renewal.
And all those planes are set to be assembled on Canadian soil. A multi-billion-dollar deal that will ripple through the economy.
Thank you for the trust you're placing in Canadian workers.
To Prime Minister Mark Carney, this is an example of the benefits of diversifying markets beyond the United States.
Countries that have the confidence to open up, to link their economies, to invest in their workers, to move forward, not turn back.
The A220 has a turbulent history. It was once Bombardier's C-Series, bailed out by Quebec, which still owns 25% of the program. Airbus has yet to break even and has faced delays getting the aircraft rolling off the assembly line. But it says it's ramping up production.
I bought AirAsia for 25 cents.
The head of AirAsia, entrepreneur Tony Fernandez, acknowledged he's taking a risk, buying just as the airline industry faces a jet fuel crisis. He expressed confidence in Airbus and Quebec's aerospace industry, which earned him a Montreal Canadiens jersey.
It's the 4,000 workers here in Mirabel. that we appreciate all your hard work.
Fernandez also pushed Airbus to produce an elongated version of the long-range A220, saying if Airbus built it, he would add it to his fleet.
Rumors of this deal had been swirling for months, and Airbus faced stiff competition from rival Embraer before landing this big deal. Geneviève Beauchemin, CTV News, Mirabel, Quebec.
Knight Therapeutics is a Canadian specialty pharma company based in Montreal, and the company's shares are trending higher after reporting record results in the first quarter. Let's find out more. Joining me now is Samira Sakhia, President and CEO of Knight Therapeutics. Samira, thank you very much for joining us.
Thank you, and thank you for inviting us.
A very good quarter. What led the way for you?
A whole bunch of different things. A lot of execution over the last several years. That's really driving a lot of our growth. We did have a couple of acquisitions in the Canadian territory, which provide some of that growth. But what I'm really proud of is our promoted products, both our pipeline launches as well as our strategic brands that are continuing to grow and drive a lot of profitability.
And what gives you optimism that that growth can continue in this trajectory?
So we did have in this quarter a shipment to the Ministry of Health of Brazil for one of our products. That being said, because the rest of the portfolio is also growing, that's really, we did increase our guidance because of the performance of some of our products in Canada, in Colombia, in Mexico. And our team has been executing really well. We have more launches coming up. They don't drive a lot of numbers in the first year of launch, but really set us up for that long-term growth.
And with Brazil, just staying there for a second, they brought in the new product classifications. What kind of an impact is that having for you?
The reason we're really starting to show the classifications a bit differently is to really have our investors understand how we internally manage our business, which is what are we promoting? What are the drivers of growth? The drivers of growth is those strategic products. They've been around for a while, but still have are close to achieving their peak sales or have achieved their peak sales. Really the pipeline, which is really the driver of the future, is what we are doing more of and spending a lot more time on. And if I look at that pipeline, we've provided guidance that we expect our pipeline products that are in early launch or to be launched will be achieving at least $200 million of revenue. And as we noted in our statements, 40 million on the products that we've achieved we've already achieved on a trailing 12 months basis, $40 million of top line from those launch pipeline products.
And what are some of the products? Let's talk a little bit about that to let people know more. What are some of the products and which are the ones that you have a lot of confidence in moving forward?
Perfect. That's a great question. So we have a whole bunch of products in LATAM. Minjuvi is one of the big ones that we launched it in 24 in Brazil. We've launched it in Mexico last year and in Argentina earlier this year. It was launched in one indication. This year, we're already launching it in a second indication that we got approval for. We look to launch that second indication, hopefully by early next year in a couple of other countries. And that's got a lot of growth coming towards it. We've got, in Canada, we are launching Jornay PM, which is a product for ADHD in children. We have a whole bunch of women's health products with Imvexxy and Bijuva, which are hormone replacement therapies. We have Myfembree, which is for endometriosis and uterine fibroids. We have a couple products in prostate cancer. So the list is ongoing, and this is really the raison d'être, the reason that we do what we do, which is to bring innovative products to our key markets that make a difference in the lives of patients. And we do this all the time. The exciting part is that we've been licensing these products over the last 5 years. We've gotten them approved, and now they're really hitting the ground. We're launching them. And as we're launching them, our shareholders can now see, our investors, that those brands are needed in our territories. They do have an impact, and they are growing because of that.
I was going to say, with women's medical products, I imagine there must be a huge opportunity there for you.
There is the way we look at each, whether it's a product or a product category, is really where is there a need, where is there a pipeline, and what can we bring to our territories, whether it's Canada, whether it's Latin America. Obviously, we're always looking to license products for all of our territories, but sometimes maybe the partner is here already for themselves, or the issues of pricing and reimbursement in Canada does not work. And so we may license for LATAM only, we may license for Canada only, but our objective is to continue to bring innovative therapies that benefit patients, physicians, the healthcare system, and that can drive long-term shareholder value.
And now you do face competition, generic competition. How are you handling that? What are your biggest challenges with it?
It depends on the product. It depends on the territory. We do have some older products in Canada that have been genericized. I mean, when I look at the Paladin acquisitions, a lot of those products that are mature already have generics. So they're really, that decline has happened. And so they've plateaued. If I look forward, there's a few products in our Latin American portfolio that are either going to face or are starting to face generic competition. The issue is that in Latin America, the way the market works is very different than here, and the genericization takes a lot longer. In Canada, you lose your market share within 12 months. In Latin America, that takes 3 to 5 years to kind of go to that 10 to 20% market share, which allows us to kind of continue to work with that product, benefit from the cash flow while we're launching and investing in new products that hopefully go beyond that decline.
Okay, one last question. With guidance for the rest of the year, where is that? And what are some of the concerns you have for managing development risk or any potential development risks?
Sure. So we did increase guidance to 510 to 525 million. Some of that's coming from currency, a tiny bit of that. The rest of it is coming from the growth or the forecast that we're having for some of our products in Canada, in Colombia, and Mexico, where the teams are executing really well. The risks that I see is we're a licensing organization. We don't do a lot of development. The issue is, how quickly can we bring in more? How do we take what we have, get it submitted, get it approved, get the right pricing and reimbursement for it to be impactful and successful? And that's something that we're doing all the time, but it is now accelerating, and we need to keep that momentum.
All right, Samira, thank you very much for joining us.
Thank you so much.
Samira Sakhia is president and CEO of Knight Therapeutics. When we come back, Hammond Power reported increased profitability and sales in its first quarter. We'll hear more from its CEO on what's next after this. Profit fell in the latest quarter of BCE, but topped analysts' estimates, supported by growth in revenue and strong performance from its business and media divisions. Bell Media continues to benefit from digital streaming growth, including gains at Crave and sports streaming platforms. Bell also highlighted rapid expansion in AI-related business services. BNN Bloomberg, of course, is owned by Bell Media, which is a division of BCE. And we'll find out more when we speak with BCE President and CEO Mirko Bibic. That's coming up tomorrow on The Open at 10:10 a.m. Eastern Time. Shares of Sherritt International are plunging off by 30%. The Canadian mining company is suspending participation in its joint venture in Cuba. The move follows expanded U.S. sanctions, and though the company has not been formally designated under the executive order, it notes a designation could occur at any time. Sherritt is bringing employees back from the island and says there's no immediate impact on its Canadian operations. Shares of Maple Leaf Foods are seeing a surge in today's trading. That's after first quarter sales came in ahead of expectations as the company continued to see steady momentum across its business. Maple Leaf says the results were driven by cost controls and a stronger product mix. The company also expects to improve margins and solid cash flow generation during the quarter. Looking at the markets, And TSX starting a little bit of a rally after peaking in the red earlier today. It's up by 0.35%. And south of the border, pretty much a similar situation. Everybody in the green right now. You've got the S&P 500 up by 0.15. The Dow is up as well, and the Nasdaq up by more than a half a point. Hammond Power Solutions reported increased sales and profitability in the first quarter of the fiscal year. The manufacturing and power quality equipment company saw a growing demand across its core U.S. and Mexican markets. Here to break it down, the results, the outlook for the rest of the fiscal year is Adrian Thomas, the CEO of Hammond Power Solutions. Adrian, thank you very much for joining us.
Good to be here, Roger.
What's driving this success in the U.S. and Mexico?
Well, look, I think the strong first quarter really came from electrification tailwinds as a whole. We operate in diverse sectors, but certainly we see increasing revenues coming from our data center business.
And is a reason? I mean, it's for the most part, I would say there's reason for optimism. But from your side, seeing more of the numbers, do you see that being sustained?
Yeah, what we saw, and what's really amazing with the record sales we posted this quarter was that we continue to see backlog growth. And so high quotation activity plus backlog growth as we're shipping more than ever really shows to the durability of the demand for electrical equipment.
I think your backlog's at 122% at the end of 2025. Any concerns that's too much, or can you handle it?
We've been building out capacity. We just finished a new factory in Mexico. That's starting to ramp up. That was helped in part driving some of our profitability gains. The 90-point margin increase came in part from price realization, but also the ramp up and the better absorption of that factory. So we have been building out capacity, and we'll continue to look at doing so.
And where do you see the next build-out coming from for capacity?
So I think when we look at that, there's a lot of different factors that going into the where. I think the question is not if, but where and how much. And at the top of that strategic thought process is how we can best serve our customers. So we like to be close to our customers. So we'll look at how we can best serve them and what location, and we'll go from there.
And are data centers your sole source, or are you looking at growth elsewhere?
No, one of the important things through this growth has been for us to continue our focus across the broad spectrum of the sectors we serve. So we're serving a lot of electro-intensive industries, so things like mining, oil and gas, the renewable sector. All those continue to have good demand. Obviously, the data center demand has been growing quite fast, particularly in the U.S., but we see also things like healthcare and other large infrastructure projects driving additional revenue for us.
And what are some of the opportunities there with healthcare and those large infrastructure projects?
Yeah, so I think those are driven by investments as what are connected to sort of economic growth and population growth. And what we do is we provide critical infrastructure into those facilities. So both with our transformer, and we also announced an acquisition of a company called AEG Power Solutions, which should be closing this quarter. They also provide power quality and uninterruptible power supplies to ensure electricity is flowing reliably to those mission critical applications. So those are all the sort of opportunities that we have as the world continues to electrify.
And what kind of savings do you think you'll see with AEG?
So the AEG acquisition is more strategic versus a kind of synergistic on the cost side. They complement us quite well, both geographically. The main focus for us was portfolio diversification. Our sales in North America are predominantly dry type transformers. AEG will bring us a lot of power quality and power electronics technology. Their revenues are primarily stemming from Europe today, and we think there's opportunity for us to learn from each other on the nuances of our geographies. And finally, they bring a lot of services and aftermarket, so that provides some earning stability through economic cycles.
Could you see yourself going to Europe with this from your side, going over?
Look, I think there's opportunities on both sides. In the beginning, we'll be very deliberate in terms of integration. So the leadership team there has done a great job to develop that. So we'll first and foremost ensure that they continue on business development trend. But there are opportunities, I would say more so, for looking how we can leverage AEG products into the North American market space.
And do we see any more M&As in the future?
I think AEG is sort of step one in building out a integrated electrical solutions division or platform, as you might say, gives us critical mass. And so, acquisitions will continue to be part of our capital deployment going forward.
All right. And a possible headwind, CUSMA's coming up. What are your biggest concern? Is it tariffs? Is the fact CUSMA maybe doesn't get re-signed? How are you treating it right now?
Yeah, I think, we can't control the trade environment. What you did see, the products, our transformers are CUSMA compliant, although we saw last year inclusion in the 232 tariffs. So, we can't control what happens there. What we can control is how we respond. So we will focus on pricing, sourcing, operational execution. The best thing that can come out of that is, businesses, we like consistency and stability. So we'll adapt how we need to adapt, and having a stable trade platform would certainly help, but we'll respond as we need to.
All right. And you've run up some debt. You're up to $18 million from $15 million at the end of fourth quarter last year. What were some of the factors, and how do you see yourself dealing with this?
Yeah, so a lot of that, we've been building out capacity. So we've spent around $90 million over the last 4 years to continue to increase our ability to produce. With the new facilities ramping up and with higher revenues, will improve our cash flows. The acquisition will put us into some term and revolver debt, but we believe we can deleverage that fairly quickly.
And any concerns with labor costs going up, with skilled labor, inflation pressures on income and things like that?
So I think the biggest thing on labor is availability of labor and skilled labor. So in our business, labor is a relatively small part of the overall cost, but having highly qualified skilled labor and retaining them is important. So we focus a lot on that. We are all our sites are recognized as a great place to work. And so I think creating the environment where employees want to stay is the most important thing we can do to make sure that we've got a good team delivering.
All right, one last kind. I'm going to let you toot your own horn for a second. Stock's up 240% this past year, 450% since you took over. What are some of the key things there for that?
Look, I think we're encouraged by the investor confidence, but I can't control the stock price. What we're doing, I think what investors are seeing is that we're in industries where there's some very significant tailwinds that are long duration tailwinds. I think electrification is not going away. And so we're just focused on servicing our customers. The faster we can convert backlog, faster they get their products, managing our costs to remain competitive, and investing in our future. So that's what we can control, and that's what we're focused on.
All right, we'll wrap it up there. Adrian, thank you very much for joining us today.
Thank you.
Adrian Thomas is CEO of Hammond Power Solutions. Up next, BCE beats earnings estimates as its big bet on AI starts to pay off. We'll have more after the break. BCE, our parent company, posted higher than expected first quarter earnings, driven by rapid growth in its AI-powered business. The company's revenue rose. Shares are pretty much flat, though they're up slightly. And the company says new AI investments are setting it apart in a tough telecom market. Let's get more on the results from John Butler, senior analyst for telecoms at Bloomberg Intelligence. John, thanks very much for joining us.
Yes, good morning, Roger. Thanks for having me.
Is a bit of a surprise this, or in line?
It's in line, and I thought it was solidly in line. And as you can see from the price action in the stock, I think the market agrees with me here. I think Bell is doing the right thing. They're really looking to tap higher growth adjacencies as that core wireless and wireline business slows. But having said that, they're still reliant on the latter two for growth. And I think the execution there was good, particularly given this slower backdrop.
So, and the higher growth adjacencies being AI, things like that?
Yes, so you alluded to it. They are building these AI data centers, the most recent one under construction in Saskatchewan. And they're very excited about it, I think, for good reason. There's a lot of growth to be had there. And I think it pairs beautifully with that fiber network that Bell has, because you need to interconnect the data centers to each other and to end users. So it's a natural adjacency for them. That project is well underway, and they are pushing hard on expanding that business to business, the B2B business, where they've always had a stake, but they're growing it now, and they're directing a lot of their capital over to these higher growth adjacent markets like the B2B business.
Just going back to the data center, I mean, there a lot of pressure on the CapEx and free cash flow. Any concerns about that?
Not really. Again, I think they're siphoning off, if that's the right word, or reducing their investment in the more mature, slower growth areas like wireless, the legacy wireline business. They view the Canadian fiber business as one that's too heavily regulated to merit investment. So I think you're seeing a redirection of spending in addition to growth there, to be fair, but more a redirection from those slower growth legacy areas like wireless and the Canadian fiber market.
So that 113% growth in AI-powered solutions and Bell Business Market's 9.7% revenue growth trajectory, are those attainable, and can they continue with them?
I mean, that's the area to watch. They're growing off a small base, so the numbers are going to look very big. But again, at run rate, you're looking at 20 to 30% growth in revenue in the data center segment versus very low single digit in wireless. In fact, wireless this past quarter was really competitive. If you look at pricing there, it was clear the gloves were off, and it was a real battle for subscribers using price as the main weapon. So I think BCE is making all the right moves here, but it's a transition that's going to take time. They're guiding to completing their build out goal of 73 megawatts, which is how they measure data center capacity by 2028. So it really is a 3-year glide path here, and nothing that's going to happen overnight.
All right. And with wireless, is that almost a race to the bottom right now between all the companies, between all the telcos? Because we're stagnating. There's stagnated growth. There's only so many people around. Who do they reach now?
Yeah, I mean, it's you just hit on it. It's a saturated market. Having said that, I was really impressed with how Bell executed during the quarter. They took a step back and said, we're not going to compete hard on price. We'd rather attract premium subscribers to the Bell brand. And, they had decent net additions, which is how you measure the heartbeat of wireless. They had about 17,000 contract net additions or loadings during the quarter. Which really impressed me. What happened, of course, is pricing took a hit. It was down a little less than 1%. And that really can affect your revenue growth in the quarter. So service revenue fell modestly during the quarter, less than 1%, 0.6%. And that's what impressed me. They really didn't participate in that race to the bottom, as you described it.
And with the premium subscribers, what are they doing to attract them? And is there more you think they could do?
So one thing all the carriers are doing, and I think Bell's in a particularly good position to do it, is bundling. And that's where you sell wireless and broadband together. What you find with a subscriber like that is they tend to be lower churn. They tend to be less apt to leave for another carrier. So they're very sticky. It's a great customer to have. And with the bundled pricing, you can attract them in at, say, a discount that runs for 6 to 12 months, and then they move on to more regular pricing. And as I said a moment ago, they're very hesitant to leave, and so you've got them for quite a long time. And that's what all the carriers are after, those long customer lifetime values, or CLVs as they call them. So Bell is executing well there. They've got a huge fiber base within Canada, so they can really execute on this strategy across a large base. And to me, that's their real advantage.
Well, we have to wrap it up there, John, but thanks very much for joining us. Appreciate it.
Thank you.
John Butler, Senior Analyst for Telecoms at Bloomberg Intelligence. Coming up, MDA Space reported a beat in revenue in its latest quarter. We'll hear from the CEO after the break. MDA Space reported a beat in revenue for the first quarter. We got more from Mike Greenlee, the CEO.
The teams are doing a great job executing on a number of large programs. And so just got a little bit more work done than planned, so a bit higher revenue.
I want to talk more about the new Chorus program. I wonder, first of all, can you just tell our viewers who maybe don't know exactly what it is, what it is?
Sure. One of the three things that MDA Space does is Earth observation. We're using radar-based satellites. And so this is our fourth generation of radar satellites in Canada. And Chorus is going to be launched later this year. We've invested in it, our single largest investment we've ever made as a company, in our next generation Earth observation satellites. And so there'll be two satellites that work together as a team. The first is a broad area surveillance radar satellite. They can look down at the Earth with like a 700-kilometer wide swath of the Earth. And then about an hour and a half behind it is a zoomed in radar satellite, so that if you see things when you're scanning, you can say, oh, I want to look at that closer, and then quickly get the following satellite to zoom in and look at that. We call that tipping and queuing. And it's a new world first commercial service in the radar satellite business, and we're really excited about it.
What data are you expecting by the end of this year when it comes to that program?
Which data?
Yeah.
Is that what you said?
Yeah.
Yeah. Well, right now we operate RadarSat-2 in the orbit, and so we deliver radar-based Earth observation data to customers around the world. We are now in the process of testing this Chorus capability so that it can be launched in the fourth quarter of this year, at the end of this year, and so it'll start to provide those data services to our existing customers and a number of new customers. We've announced that we have about 41 different agreements, 9 of them signed contracts, the other 30-odd letters of intent that we are working on converting to contracts as we get towards launch at the end of the year.
That seems like a pretty decent number of customer contracts moving forward. Like, I'm curious why you're maintaining guidance rather than increasing it with that in mind.
Yeah, that won't really change revenue this year. When we launch the satellites at the end of the year, they'll go into service. It'll take a few months for them to go into service in early 27, and then they'll start generating revenue. So all these agreements get everybody ready to receive that service. In addition to, in some cases, us doing what's called ground station upgrades, is updating their ground stations to send taskings to us and receive data back from us. So all these things get done in preparation for that launch and entry into service. And then as we go through 2027, we will build in our revenues on top of our current levels of revenue. So we would expect growth through 2027.
On the flip side, just switching gears here, MDA Space was working on the Canadarm3 for the Artemis mission. NASA has now decided not to use that arm. What will happen now with the Canadarm3? Is it finished, or what's the process now?
No, Canadarm3 is for the Artemis mission, which you said. That was a great group of words there. And the Artemis mission continues. And so within the Artemis mission, there are a number of elements. One of them is a space station called Gateway that will orbit the moon. What NASA decided was to pause the work on Gateway. And so the robotic arms were to be targeted at Gateway to put robotics capability on that space station in that part of the Artemis program. But they won't need that right now. But they will need a lot of robotics capability down on the lunar surface on the moon for rovers, for loading and unloading, logistics handling, and other tasks. And so we're working, the Canadarm3 program continues. It's to develop robotics for the Artemis program. We need to have a series of discussions finalized to finalize exactly which applications those robotics will be targeted at as we complete the project. In addition, this project being delivered by Canada is also to ensure that we have a strong technology base for our commercial robotics offering, which we call MDA SkyMaker, that we take to the rest of the global market. So Canadarm3 continues. It's got lots of application areas. We just got to have some discussions to be able to, in some cases, on the lunar side of the moon, pivot the robotics from the space station down to the lunar surface.
Okay, I understand. So you do still have a partnership with NASA then, and that project does continue.
With Canadian Space Agency, and then they have a relationship with NASA.
Okay, got it. Just speaking about the industry as a whole, because obviously there's a lot of talk right now about SpaceX with an IPO, a potential IPO coming later this year. Do you think that will release more money into the industry? Will that impact MDA Space at all moving forward?
Certainly, we would expect the SpaceX IPO to increase enthusiasm about space in the industry. We've seen a number of IPOs, including our own, on the New York Stock Exchange a few weeks ago. We've been listed on the Toronto Stock Exchange, and now we're dual listed on the New York Stock Exchange as well. That was a very strongly oversubscribed offering where we raised about $340 million, but could have raised a lot more should we had wanted to or had a reason to. A number of other firms have gone public at really good valuations as we've gone through the years. So the interest in space continues to increase strongly in the market. The SpaceX IPO will be of a size, of course, that it will really cause everyone to be talking about space at a new level of intensity, and that can only be good for the sector. The space economy is maturing. It continues to open up and expand, and it's important for people to realize it's a persistent economy. There's not some blip here. We don't just do like a stunt and go to the moon and come home. Like space and the moon are now opening up as persistent economic activity areas for us to all continue our work on.
That was Mike Greenlee, CEO of MDA Space. Thanks for watching Morning Markets. We'll see you back here tomorrow.